We had that real spike in silver back in January, early February, where it ran from I think $50 up to 122. I actually at that point said we could see something like a 35% um, you know, pullback in silver, having had it go up having had it go up parabolic. And so I expected a sharp sell off, and I thought it'd be pretty quick. It turned out to be, a lot more than 35%. It was down 50%, I think. So it got down to 66, I think, overnight in that first sell off. And then, we retested and went through that 66 down to low 60s and are coming back out of that. So I think the lows are in clearly, in my opinion. I think it was something where people were getting far too ahead of themselves and the bullishness was far too high.
David Hunter explains that silver recently experienced a sharp rise, jumping from around $50 to $122, but then dropped significantly, about 50%, due to excessive market excitement and external factors like war. He believes this correction was necessary to remove overly speculative investors and that the market has now likely reached its bottom and is starting to recover. Because of this, he increased his silver price target to $180 and gold to $6,800, expecting a strong upward move in the coming months. However, he also warns that this rally may be in its final phase, lasting another 5 to 8 months, before a broader global economic downturn affects most assets. Despite that, his long-term outlook remains very bullish. He believes that in the early 2030s, gold could reach $20,000 and silver could hit $500 or more, driven by a major inflationary recovery cycle after the downturn. If you find the content helpful, hit the like button and feel free to share your thoughts in the comments.
So it shook out the weak hands. We had lots of reasons why it went down. Certainly the war was the biggest one. And I see it now with it, where's silver now? I guess, probably low 70s. I see it. I raised my targets actually when that sell off happened, that first sell off down to 66. I raised my silver target to 180. I had a 125 target coming into this year. I think I may have raised that in my first quarter letter. And then a month later, I raised it again to 180 when I saw that sell off. So I do think that, there's a huge upside here. If we're at 70 or thereabouts and we're going to 180, obviously that's a big number. I think we could be there this summer. It doesn't have to happen by Labor Day, but it could. And gold, same thing. I raised my target there to 6,800. The correction that we've just had, I think, clears things out so that there's another big run. So, with silver running with gold, in the mid to high 40s, 4,000s, I see it going to 6,800. That should be the upside for this cycle. Obviously, there's possibility that even those numbers are too short, too conservative, and that could go. But I think the top is this year in metals because I think we're heading for a global bust that will hit all assets or pretty much all assets other than treasuries. So, on the downside, I don't know where we'll go because we got to see where we end up on the upside here. But I do think that we're in the final stretch here, meaning the next 5, 6, 8 months of the metals bull market before they have a big consolidation through the bust. And then coming out the other side, we'll see much higher highs in both metals in what I think will be a big inflationary recovery cycle. So, but that's 27, probably 28, 29, 30, and, the early 2030s. You could see gold get to 20,000. You could see silver get to, I have had a long-term target of 500 on silver. With what's happened this year in silver, I think I'm probably way too conservative on the long term in terms of where silver goes. So that, unlike stocks, where I think the top this year is going to be a high water mark for a decade, maybe a couple decades or longer. In the metals, highs this cycle will be exceeded by a lot next cycle.
David Hunter says the market got overly excited expecting Donald Trump to end the war, but when that didn't fully happen, prices pulled back and oil went up. He believes this drop is temporary and the market has likely already bottomed. He expects a strong rally in the coming months with stocks and metals rising sharply, possibly reaching very high targets by summer.
I think the market got a little ahead of itself yesterday, and there was talk that Trump was, the president was going to, in his speech last night, declare the war pretty much ended, and I think people got overly excited on that, both in the stock market and in the metals market. So when he basically said we're winding this down, but there's still a few weeks to go, and we feel we can declare victory in a lot of ways because we've destroyed the Navy and the Air Force, et cetera. But there's still work to be done, and we need to open the strait, and we need to see whether the leadership there will come around and agree to negotiation points. Once it became realized that he wasn't really saying anything new, and that this thing could get stretched out, up went oil and down went the market. So I view that as nothing more than expectations got a little ahead of themselves. I do think the odds are pretty high that we did bottom out, but last Friday, I guess it was, or somewhere around there. And in both the market and the metals, I think have bottomed as well. So I'm pretty constructive going forward here. Obviously, we had a sell-off this morning, and oil's WTI is up over $111. So that's spooking some people. But I think the market's selling off in an early way here, and basically giving back some of the excitement from yesterday. Get beyond the day-to-day here, I really think this quarter is going to be a very big quarter for both the stock market and the metals. I think what we saw there, we had a high-level consolidation going on in the stock market that had started basically late last October, and it's kind of staying in a range between 3 and 5% down, and then things got nasty in Iran. We went to war, and the strait got closed, and oil spiked. And so you went down. The S&P went down 9%. I think the Nasdaq may be closer to 13. But I think basically, if the war had not happened, I think you were just having a normal high level consolidation for another leg up. The sell-off went deeper than certainly I expected because of what happened in Iran, but I don't see it as any different. I think the second quarter is going to be that next leg up into a top. So I'm expecting my targets, which I raised I think in my fourth quarter letter last October, are S&P 9,500, Nasdaq 32,000, the Dow 65,000. And the Russell 3,800. And I haven't done the math in the last week or so, but I think if you do the math from recent lows, you're talking about a 45-50% move. And so a little less than that from here. And I do think that we could see that by this summer. So that would be a basically unprecedented rally or pretty close to it.
David Hunter says that even though people think a 45 to 50% market rally is impossible, it has happened before, so it can happen again. He explains that fear in the market is actually a wall of worry, which often fuels a strong upward move. He believes this quarter could see a historic rally as fears fade and optimism returns, especially if the war situation improves. However, he also warns that by summer, markets could become overly bullish, which usually signals a major top before a downturn. He also expects interest rates to fall, which could start a strong bond market rally and further support stocks in the short term.
People have to remember coming out of the last April swoon, we had, a 40% plus move in the S&P. So people, when they hear it's going to go up 45 or 50%, go, that's impossible. It can't do that in less than 6 months. And I said, it just did. And we're not coming out as deep a hole, but we're still, I think what this has done in terms of the closing of the strait and people's fears of what's going on in the Middle East, what it's done is built that wall of worry back up to a level that's very high, and yet only with a 9% correction in the S&P. That's pretty unbelievable. And what that wall of worry is fuel for the next advance. So I am saying, that the second quarter could be a historic quarter in terms of the upside. You certainly wouldn't know that right now with the S&P down 50 points and previously down more than that this morning. So, but I do think this thing runs its course pretty quickly as we kind of wind out the expectations that were built up yesterday, and then we move back up again. So I realize there's a lot of people out there talking, a lot of strategists and analysts talking, oil to 150, oil to $200. It's going to create a bad economy. There's all kinds of negative views out there. If this thing runs its course in the next few weeks, and I do expect that, doesn't mean the whole thing is resolved. It does mean that, the worst of it will be behind us. I think there'll be oil flowing. And I think if people can look ahead, what you're ultimately going to see here is maybe the most peaceful Middle East situation we've had in, 60 years or more. And people aren't, they're so caught up in the very short term. I realized Iraq and Afghanistan were long wars. They didn't go well. They were executed very poorly. This is very different. Trump is not George Bush, and Trump is not Obama. He really does say, we're going to get in and get out. We're going to get this done. He gives his military marching orders of what they need to do, what the objective is, and then he lets them execute the war. And that's really why I think this thing in a lot of ways has gone well. Now, certainly the mainstream media, certainly, the market's nervousness, certainly those who have no appetite for a war are all very negative. And, we really, at this point in time, as a country, half the country has zero tolerance for any kind of, war or military operation. And it's because of what happened in Iraq and Afghanistan. But sometimes, and, Trump's declared this many times, his view is peace through strength. We're going to get these things cleaned up quickly. And what he wants is basically a peaceful world where capitalism can take root. And I think that if people can look past this, what I think will turn out to be short term, you're going to see, I think, as we go through this quarter, that optimistic views start taking place in the market, start being discounted in the market. And then I think sometime this summer, it's going to be too euphoric, too bullish. Sentiment's going to be up at the top. People are going to tell you that, the economy can go on for several years here, that with the war behind us and oil dropping, that inflation is not a problem, the Fed can ease. All those things, I think, are going to be part of the narrative that drives us to the top. And when everybody's all in, is when I'm going to be saying, I think this thing is near the top of a 43 and probably pretty close to a 44-year secular bull market top. And I'll be talking about the other side of the mountain. So that's kind of where I'm at in terms of, the stock market. The bond market is, I think, rates have been in a 2.5-year top, basically. Bonds in a 2.5-year bottom in formation. I think if we get the 10-year down under 4.25, it's pretty clear sailing to, I think you could see 2.5-3% later this year. And nobody's expecting that. Everybody's talking about rates going up, not down. So again, There's a lot of bearishness out there, a wall of worry in the bond market. I think once we start seeing rates go the other way, the move up in the 10-year above 440, almost 450 intraday, spooked people, and all of a sudden heard calls for 5% again, etc. And I think it was kind of a last hurrah on the upside. My expectation is we're going to break that 4.25 here shortly, meaning in coming days. And I think from there you'll see a bond bull market. So you'll have a bond bull market, a stock bull market.
David Hunter says silver and gold saw a sharp rise, then a big correction due to overexcitement and war, but the market has likely bottomed and is set for a strong rally with higher targets ahead. He believes recent pullbacks are temporary, and current fears are a wall of worry that can drive a powerful market surge this quarter. However, he warns this rally may peak by summer with extreme bullish sentiment, followed by a downturn, although falling interest rates could support markets in the short term. If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. Furthermore, share your thoughts in the comments section. We appreciate your support, and we thank you for being with us. Wait for the next updates. Thank you.